Welcome to 10 Section 1031 Exchange Pitfalls to Avoid. I'm Scott Saunders, and I'm a Senior Vice President with Asset Preservation. Just to start off, a quick disclaimer. This presentation just covers a variety of issues, but it's a broad overview of some issues that relate to exchanges. It is critical that you as a real estate investor get your tax and legal advisors involved prior to closing to review your unique facts and circumstances. So keep that in mind. Now, to start off, the number one exchange pitfall deals with timing on the sale of the relinquished property. And this is really broken down into two subsets. Number one, trying to set up a 1031 exchange at the very last minute can be problematic, particularly in a market where there's a lot of activity, where closings and transactions are happening with fast and very quickly. It may be very difficult to get the 1031 exchange documents in place prior to closing if you don't do it well in advance of the 1031 exchange. Now, the second aspect of this one is even more problematic. This is where somebody intends to set up a 1031 exchange, but the right documents are not in place prior to closing on the sale of the relinquished property. So maybe the investor intended to do an exchange, but they didn't communicate that to the right parties, nor did they get the 1031 exchange documents in place prior to closing on that sale. They didn't get a qualified intermediary involved. And unfortunately, we see this every month where many investors maybe intended to obtain tax deferral, and they realize after the transaction's closed, after the burdens and benefits of ownership have passed from one party, the seller, over to the buyer, they realize that after the fact. So there is no way to set up a 1031 exchange after the relinquished property has closed. And a couple terms to be aware of. The term actual receipt is pretty straightforward, probably makes intuitive sense. If you actually receive the proceeds, you now have a taxable sale because you have those proceeds. You cannot do a 1031 tax deferred exchange. The other one's a little bit more difficult to understand, but the term constructive receipt just means you're legally entitled to those proceeds, such as having them held by a title company or a closing attorney or an escrow company on your behalf. So the transaction closes and maybe the proceeds sit at that title or escrow company, but it was closed on your behalf. They're sitting in the escrow or trust account at that company. You're legally entitled to those. That's called constructive receipt. It essentially results in a taxable sale. You cannot set up a 1031 exchange in that regard. Now, the second exchange pitfall deals with timing on the purchase of replacement property. And I'll tell you, right now, it's fairly easy for a real estate investor to sell a property if it's priced properly. Where the big challenge is on the inventory on the purchase side, because those properties, if they're priced quickly, they're going to turn over relatively fast. So a couple of tips. One way to approach this would be to start looking for suitable replacement properties when you list your relinquished property, particularly if you think it will go under contract fairly quickly. That's probably a conservative approach. Certainly, as soon as you have the relinquished property under contract, you've got a buyer and you've agreed to terms and a closing date. At that point in time, you want to start looking for the replacement property. So the 1031 exchange time deadlines, which I'll cover on the next slide, they don't start officially until the property closes. The sale of the relinquished property closes. Keep in mind, particularly in a market like we've been seeing recently, if we've got a seller's market where there's not a lot of inventory and properties come to the market quickly, we're seeing a very unusual scenario. Typically, we have the listing price being the ceiling on a purchase, and you negotiate down. In a seller's market like we're seeing now, it's the opposite. That listing price typically becomes the floor, and there are escalation clauses built in, and there are multiple property people that want to buy that property bidding for the replacement property, driving up the price. So a challenge in the marketplace is just finding replacement property. And this varies. It obviously adjusts to different market conditions, but right now the inventory is fairly low. And so you want to start looking for that very early in the transaction. Focus on that aspect of it. Just a quick review for those of you that are not very familiar with the time deadlines. When you close on a property, you have 45 calendar days. That's called the identification period to identify a property that you want to buy. You then have another 135 days after that. So a maximum of 180 calendar days to close on the replacement property that you've identified. So it's a maximum of 180 days. That's the exchange period. The first 45 days is what we call the identification period. And that's the time that you have to identify potential replacement properties that you want to acquire. Exchange pitfall number 3 is not identifying any potential backup replacement properties. So sometimes investors negotiate on that ideal property and they really want it. And yet they don't put down maybe their second and third choices or some backup properties in their identification. If you identify one property, and if after day 45 that property doesn't work out, maybe you do your due diligence on it, maybe it's a property inspection, maybe you find some problems with the property. If you only identified one property and you're after day 45, you're now going to be paying the taxes in a taxable sale because you've only identified one. You no longer want to purchase that. Therefore, you've got no other options available. So in a 1031 exchange, if you can, it is always a good idea to maybe have one or two backup replacement properties identified so that if that first property, the one you really want, doesn't work out, you've got a couple of other options that have been properly identified in the exchange. Just a quick review of the identification rules. Under the 3 property rule, you can sell a property and identify 3 properties of any fair market value. So you sell for $1 million, you identify one at $1 million, one at $1.3 million, one at $3 million. The value doesn't matter, but you're limited to 3 properties in that scenario. Under the 200% rule, you can identify as many properties as you want, but no more than 200% of the value of what you sold. So if I sell for $1 million, I could identify up to $2 million in replacement property. So the 3 property rule is you're limited to 3 properties and unlimited value. Under the 200% rule, you've got an unlimited number of properties, but no more than twice the fair market value of what was sold. And then finally, although it's rarely used under the 95% rule, or what I call the 95% exception, you can identify more than 3 properties and more than 200% of what you sold, but then you must actually close on and acquire 95% of the value of the properties identified. Keep in mind, when you're identifying, you have to identify specific properties. They must be unambiguously described. So that's typically going to be a street address or a legal description. If it's a piece of land, it could be the assessor's parcel number. And that has to be done by midnight of the 45th day. That's kind of the cutoff there. The 4th exchange pitfall deals with LLCs and partnerships. So many investors own property in an LLC, a limited liability company, or in a partnership. And sometimes on the sale, some LLC members or partners would like to receive the cash and pay all the taxes. Other LLC members or partners would like to structure a 1031 exchange. The problem comes when you own an LLC member interest or partnership interest. You own an interest in an entity, the entity owns real property. Your interest in an LLC or partnership is a personal property interest. You cannot do an exchange on a personal property interest. In fact, an LLC member interest and a partnership interest are excluded from Section 1031 tax deferral. So what you've got to do is, in essence, in a situation where some people would like to sell, others would like to do an exchange, is you've got to convert an interest in that LLC or partnership into an interest where the various former LLC members or partners own an interest in real property directly. And I'll just briefly touch upon this, and keep in mind, this issue is a little bit complex. I'm just doing a quick overview. So be sure to speak with your tax advisor and work with a reputable qualified intermediary like Asset Preservation to more thoroughly dig into these issues. So as you'll see here, a partnership interest is excluded. So you've got to convert an interest in the partnership into an interest in the real property, the capital asset itself. The two common approaches to do this, one is what's known as a drop and swap. So the swap refers to the 1031 exchange. The other one's a swap and drop format. So I'll approach the other one first. In the swap and drop format, the partnership or LLC completes the 1031 exchange. And then after the exchange is over, they're going to go ahead and distribute an interest in that replacement property to the partner or partners that went out. Far and away, the more common approach is the drop and a swap. What is done here is the partnership elects to no longer be treated as a partnership. So the partnership deeds out to the former partners where they now own the property as tenant in common co-owners. So each former partner has an interest in the real property. Those who want to sell at closing take the cash and pay the taxes. Those who would like to exchange work with separate qualified intermediaries, and they go their separate ways at the when the transaction closes. However, in a perfect world, the time with the drop out of the partnership before the closing should be as long as possible. There should be a significant period of time. The more time, the better. And the reason is you want to season it and hold title as tenant in common co-owners for a period of time where you meet the held for investment standard. If the dropout happens too closely to the 1031 exchange, there's a chance that it may not hold up and qualify for Section 1031 deferral. And you'll see on this next slide, we do have numerous tax court decisions at the federal level where people have changed their ownership. So Maloney, Mason, Boker, and they've prevailed where they changed their ownership before or after an exchange. However, if you're in California or your clients have property in California, the Franchise Tax Board, what's known as the FTB in California for state level taxes, they have been very aggressive auditing real estate investors in drop and swap type scenarios. And they've been winning in those cases. So they're coming after them for the state taxes owed. Keep in mind, California right now has the highest state tax rate in the country. The maximum state tax rate is 13.3%. So it really allows the Franchise Tax Board to go after a significant revenue source. And just be aware, way back in 2008, there were changes made to the partnership tax return. So IRS Form 1065, where you actually have to disclose, did you do a drop out of a partnership right before the exchange or right after the exchange? So you have to proactively provide this information to the IRS. So just be aware of that. Now, the next pitfall is the exchange pitfall number 5 is really understanding what is required for 100% or full tax deferral in an exchange. So the key issue is that you really want to look at two different components. You want to look at the net proceeds. So this would be after the closing costs, after real estate commission and the title company fees and recording fees. So that what we call the net proceeds or the net equity. Number one, for full tax deferral, you need to reinvest all net equity into like-kind property. Number two, and this is the one that some people don't consider or maybe aren't aware of, is you need to have the same or a greater amount of debt on the replacement property. So if I have a mortgage payoff of $200,000 on my relinquished property, I want to have at least $200,000 of debt or of a new mortgage on a replacement property, or you can split that among several. So in summary, number one, reinvest the net equity. Number two, same amount of debt or more. So a taxpayer can always go up in debt. They can always add more cash to the transaction. You may have heard the terms boot. Cash boot is when you receive cash proceeds out of a transaction. Mortgage boot, sometimes called debt relief, is when you have a reduction in the mortgage liabilities. And just keep in mind, there's one little caveat to this, which is you can have some mortgage boot, so go down in debt, if you offset it by adding new cash to the transaction. So if I have $200,000 mortgage and I only have $150,000 on my replacement property, but I bring in outside cash of $50,000 or more, I've offset my mortgage boot by adding new cash. So that's one way to do that. You can't go the other way. You can't put proceeds in your pocket out of the exchange and leverage up. That's not permitted without creating taxable boot. So keep this in mind. Very simple analysis. What you want to do is look at your settlement statement when you close. What are the net proceeds? Number two, what was the mortgage payoff? And that'll really give you your target numbers to aim for. And remember, it's the net sales price, not the gross sales price. It's net after those closing costs that are able to be pulled out of a 1031 exchange. Now, the next exchange pitfall number 6, is making sure that the property that is relinquished and acquired, that they're either held for investment or a business purpose. So held for investment qualifies, or in a business on either one of them. The property being sold, sometimes we get asked about properties held for sale, development property, maybe a fix and flip property where somebody buys it low, fixes it up, and turns it around to sell. If the intent on the property being sold is to hold for sale purposes, not long-term investment, i.e. rental income, if it's an income producing property, that is excluded from Section 1031 exchange tax deferral. So you cannot do a 1031 exchange on property held primarily for sale purposes. And that's a little bit beyond the extent of this brief presentation of analyzing those factors, but just conceptually keep that in mind. Likewise, on the property being purchased, the same thing applies. It has to be held for investment purposes. If a taxpayer moves into it right away, that's being held for personal use as a residence. That doesn't qualify. So there is the potential later on down the road to maybe have the taxpayer's intent change from holding for investment to maybe holding for a residence. So they hold it for a number of years. Maybe their facts and circumstances change, and now they intend to move into the property. That's permitted. But at the time of the exchange, both the property being relinquished, what we call the relinquished property or sale property, and the property being acquired, the purchase or replacement property, with both of them, it has to be held either for investment purposes or used in a business. That's important. The number 7 exchange pitfall would be using what is considered a disqualified person as a qualified intermediary. So keep in mind, a qualified intermediary, like asset preservation, is typically a fourth party principal that is brought into the transaction. A disqualified person is fairly broad. You can't have a family member function as a qualified intermediary, an employee, a real estate professional, or a tax or legal advice that has given you tax or legal advice within a 2-year period. So a qualified intermediary can't be the taxpayer or a disqualified person. And what a qualified intermediary does is they enter into a written agreement with the taxpayer, the real estate investor, what we call the exchange agreement. They receive the relinquished property from the taxpayer. They sell that property to the buyer, and then they receive the proceeds. They hold those proceeds subject to certain restrictions. And then likewise, they're going to step into the shoes through an assignment of the contract to purchase a replacement property. So they're going to use those funds, buy a replacement property, and then transfer that property back to the taxpayer. The exchange agreement must limit the taxpayer's rights to receive, pledge, borrow, or otherwise obtain the benefit of the money. That's really critical. Now, exchange pitfall number 8 is not seeking tax advice or tax and or legal advice prior to closing on the sale of the relinquished property. And I can tell you from doing this now for several decades, unfortunately, it's very common that an investor does not talk to their CPA before they close. They're going to look at their CPA as maybe their tax preparer after the fact in the next tax year. And that could be a problem because as a CPA or the tax advisor or the real estate or tax attorney, so consider them tax and legal advisors, they're very familiar with your individual facts and circumstances and what you need to accomplish. So you want to look at things like vesting issues, your intent, and you might want to look at things like, are there unique situations that are specific to you? Do you maybe have some suspended carry forward losses where maybe boot could be pulled out and not create a taxable consequence? So it's important to engage your advisors prior to closing on a property. Generally, it's going to be a 5-10 minute phone call to just review what you're attempting to accomplish. And I have found that making that phone call and spending the time in advance is really a smart strategy. Unfortunately, many investors don't do that. They either don't think about it or they look at their tax advisors doing the tax preparation and not bringing them in as a partner well in advance. So a good qualified intermediary will encourage you as a real estate investor to seek your own tax and legal advice with people that know your situation. Now, exchange pitfall number 9 deals with the entities that own property. So keep in mind, here's the general principle. The tax owner, the entity that owns the relinquished property, should be the same tax owner on the replacement property. And I use that word tax owner because it's more than just a vesting issue and how title is held. It's really who is the tax owner of a property. So somebody that sells a property, the way that they're the tax owner, they should make sure that the same tax owner buys the replacement property. And oftentimes, where this comes up might be where people are married, but they brought in their own individual property into the marriage. Now, maybe they want to add their spouse, maybe they need their spouse to qualify for financing, but they've treated that property as separate property that they've owned. And it can be problematic to try and add a spouse at the very last minute. So some general principles you see. Um, Keep in mind that generally the tax owner that relinquishes should be the same tax owner that purchases. So if a wife owns property, the wife should complete the exchange as their sole and separate property and then buy replacement property. Likewise, you'll see some other entities. So keep in mind there are some exceptions to this. For example, I as an individual can sell in my name, Scott Saunders. I could buy a replacement property in a single member LLC that is disregarded for federal tax purposes. That would be the same tax owner. So you want to look at federal tax ownership, state law tax ownership, and certainly vesting issues. Those are things that you want to look at well in advance of the 1031 exchange. Now, the next one is something that comes up quite a bit. Exchange pitfall number 10 is dealing with related party issues, particularly would be dealing with purchasing a replacement property from a related party. And we'll touch upon who that is. You want to be very careful about purchasing replacement property from somebody that is related to the taxpayer. And really, when we look at this, there are a couple of different scenarios. Just first off, a related party is anybody that's related to the taxpayer, a family member, a father, a mother, a brother, sister. Aunts and uncles are not related. Step parents are not related. So, also an entity that the taxpayer owns more than 50% of is related to the taxpayer. And real quickly, and this is just a brief presentation, but in a simultaneous exchange where two people that are related swap, this is permitted, but there is a 2-year holding period for both parties. Second scenario, delayed exchange selling to a related party. This is permitted without a 2-year holding period. Scenario number 3 is the one that we get asked quite a bit about. What about purchasing property from a related party? You want to purchase mom's house and lease it back to her. This is not permitted under the related party rules. So let me just summarize that again. Delayed exchange, purchasing from a related party is not permitted unless you fit into one caveat, which is scenario number 4. If you're purchasing from a related party who is also doing a 1031 exchange and the primary objective is not tax avoidance, that is permitted. So that's just a quick overview. Be sure again, involve your tax and or legal advisors to discuss any related party issues. Unfortunately, people don't really think this one through or don't understand these issues, and they're really critical in an exchange. Finally, to wrap up, the API advantage, that's our experience, our expertise, and our security. We've been doing exchanges since 1990, and we completed over 200,000 exchanges in every state in the country. We have senior exchange counselors that look forward to providing excellent service on your exchange. We've got a commercial division that handles parking arrangements, build to suit, reverse build to suit, construction exchanges. And finally, asset preservation is a subsidiary of Stewart. And as a subsidiary of Stewart, we're able to provide a written letter of assurance that is available upon request. We've got the best financial security, the security for the proceeds, and we excel in providing exceptional service on each and every exchange. Finally, if you want to find us on social media, you can see where we are on YouTube, on Facebook, LinkedIn, as well as on Twitter. And then just to wrap up, please call us. We want to be a partner with you on your next 1031 exchange. Call our national headquarters in Roseville, California, 800-282-1031, or our office in New York, our Eastern Regional Office on Long Island, 866-394-1031. And then finally, you can visit our website, apiexchange.com. We have a lot of information on there. And you can also email info@apiexchange.com. Now, this email is monitored by senior management, and we get questions all during the day, evenings, holidays. We'll monitor that and get back to you promptly with answers to your specific questions. So please feel free to reach out to Asset Preservation. Hope you've enjoyed this brief presentation. Thank you.